In this video, we are going to see the material cost calculations for a production order. For this, we already have a production order which has been uh, released. Goods issue has been posted. That means actual units of components that have been used for the production of the finished goods have been consumed. The operations which are required to produce the finished goods, they have been confirmed, and the finished goods have been received in the warehouse. So the entire production cycle has been completed. So if we go to this production order, you can check that from the status of the production order also. So you can see here the total quantity of finished goods, which is DXTR 1000, that was planned to be produced against this production order was 100. However, out of this, only 89 have been finally produced. That means 11 have been lost as yield during the various stages of production process. You can also see from the status that the goods movement has been posted, which means the components that are required to produce these finished products have been issued to the production order. And obviously, there's a variation from the actual between the actual number of units that have been issued versus the standard units that should have been issued as per the bill of material. This variation might have been because of various reasons, like while issuing materials from the warehouse, some materials got damaged, or some materials were lost in transit. So the actual quantities that were issued might have been more than the planned quantity. Similarly, the various operations that are required to make the finished product, for example, attaching seat to the frame of the bike, because this is a bike manufacturing production order, attaching the brake kit, etc. During that time, there were some processing costs that were involved, for example, labor costs, machine costs, etc. Now, the amount of cost that is incurred actually for the production order might have been different from what is there in the standard. Where do you see this? If you see the components here, these are the components that are required to make the production order. These are the standard quantities that are required. However, the actual quantities may be different, usually may be higher for the breakages and the short components that might be lost while transferred to the shop floor. Similarly, if you look at the operations, these are the operations that are required: material staging, attached seat to the frame, etc. And these are the work centers where these operations are being carried out. Now, these operations also require a standard time to be performed, which is there in the routing of the production order. However, while performing the operation, actual time required might be more than the standard time. And this has been recorded in while confirming the production order, and this will lead to the variation in the process. So entire process of confirmation and the goods issue of the production order is there in a separate video. So if you're interested, you can watch that video to see the entire process. So this particular video only considers the analysis of the material cost that has been consumed for this particular production order. The process of production can be seen in a different video. Now, in order to understand the way the cost calculations are happening for the material cost, we need to first understand the theory of multi-level actual costing based on bill of material. We will take a very simple case of a finished goods A, which requires a semi-finished goods B, and B in turn requires only one raw material, C. We are taking the simplistic case for the ease of understanding the calculation. However, in reality, we all know that there may be multiple raw materials that may be required to make a semi-finished goods. And there will be multiple semi-finished goods and raw materials that may be required for the purpose of making a finished goods. But if you take the more complex scenarios, calculating the material cost manually might be very difficult and confusing. And that is why we need SAP to do those calculations. But in order to understand the principles of the calculation, we take a very simple scenario where there is only one finished goods, A, which is made for only one semi-finished goods, B, and which is in turn made from only one raw material, C. So let us go to an Excel sheet and understand the calculations first. Now, there are some assumptions before we go ahead. So the first one, as I mentioned, is C is the raw material used to make a semi-finished product B, and B is the input component for making the finished good A. The per unit moving average price of C at the time of standard cost estimate is ₹10. Now, every material has a valuation rule. Valuation rules means that how the inventory of that material will be valued. The valuation rule is defined in the accounting view of the material master. There are two valuation rules. One is called moving average price, and the other is called standard price. In case of moving average price, inventory is valued on moving average. In case of standard, the inventory of that material is valued at a standard price. Now here, price and cost are used interchangeably. Do not confuse it with, when I say price, do not confuse it with the price at which the product is sold. That has nothing to do with this particular calculation. That price is determined by market, by the sales guy. That may be higher than the cost, that may be lower than the cost, but the cost will be based on the resources that are being consumed to make the product. So when I'm saying price here, it is actually meaning the cost. So it is used interchangeably in this context. SAP also uses moving average price or standard price in that sense, in the sense of the cost of the product. So usually raw materials are maintained at moving average price. That means they're valued at moving average price, whereas semi-finished goods and finished goods are maintained at standard price. This is usually the case in industry. The reason is that the fluctuation of the price of raw material, that means the price at which raw materials are purchased, are not necessarily in the hands of the organization. It depends on macroeconomic factors and various other things. Whereas the value at which semi-finished goods and finished goods are produced is very much to do with the internal efficiency or inefficiency of the organization. And it's one of the purposes of doing this material costing is to figure out how different the actual cost of producing a semi-finished goods and finished goods is compared to what it should be under standard condition. This is the calculation of variance as typically cost accountants do. This obviously indicates the efficiency or inefficiency in the production process. It also indicates where the efficiencies and inefficiencies lie. And this is one of the very, very important aspects of management accounting. So this is the reason why the moving average price for C is indicated here as ₹10. Now, what does this word at the time of standard cost estimate mean? Now, very soon we'll see that this moving average price of C, which is an input material, B, will be used to calculate the standard cost of B, because B is produced from C. So the cost of C must go in the standard cost of B. However, how can we calculate the standard cost of something when the input cost of that is varying? And you cannot have the standard cost of something varying every other day, because then the meaning of standard cost is lost. Standard means there's a fixed value. And then against that, you are measuring the actual value. So what organizations do is organizations calculate a standard cost at periodic intervals. Usually it is one financial year. So the beginning of financial year, every organization will fix the standard cost of a particular material, in this case, semi-finished goods or finished goods, and measure the actual cost against the standard that has been fixed at the beginning of the financial year. Now, when you are fixing the standard cost of a semi-finished product like B in this case, which requires input raw material C, you need to fix the price of C, which will go in the price of B. Because if the price of C is moving, then there is no way to calculate a standard cost of B, which is fixed. Now, what will be that fixed price of C that will be considered for calculating the standard cost of B? That fixed price is the moving average price at a particular point. In this particular case, we have assumed that at the time when the standard cost estimate of B is done, whatever is the moving average price of C, that is taken for the calculation standard. In a more sophisticated method, you might want to accommodate some escalation cost of C, because you have to maintain that price for the entire year. And if you know that there will be some escalation of price of C happening towards the throughout the year, you can estimate that price and add that to the moving average price that was there for C at the time of standard cost estimate. In this particular example, we have not taken that. We have taken that there is a standard cost, there is a moving average price of C at the time of estimation of standard cost of B, and we are taking that price for the calculation of the standard cost estimate of B. Now, B needs to be processed from C, which means that there will be certain amount of machines, certain amount of labor cost that will be involved while producing B. We are defining this as the processing cost. And the processing cost of B under standard conditions is given as ₹20. Now, calculation of the processing cost is a different subject. We will not discuss this in great details in this video. However, very broadly, what is done is essentially you first find out what are the components of costs that go into the processing of a material, let's say B. For example, it can be machines, it can be labor, it can be setup. Okay. Labor can even get divided into supervisors, workers, etc. Now, so you first divide what are the major components on which which will be incurred for the processing of the product. These are called activity types. So machine is an activity type, labor is an activity type. Then you estimate what is the per hour standard cost of using a machine, or per hour standard cost of using labor. Now note that this can only be an estimated number, because it is impossible to know beforehand which specific labor is going to work in a case of a particular production order, or even which specific machine is going to be used for a particular production. So this is an estimated value that is again done at the beginning of the standard cost estimate, and says that for making B, you need so many hours of labor as standard, so many hours of machine, so many hours of setup, etc. Then you multiply that with the rate of using the machine for 1 hour. How will that rate be derived at? The rate will be derived at the costs that are required to are incurred to run the machine. For example, the cost of depreciation, the cost of electricity, maybe the cost of lubricants, maybe the cost of maintenance. So you estimate that what will be this cost for running 1 hour of the machine and put that as a rate. Note that none of these are actual costs. They cannot be actual cost or actual rate, because actually which labor is working, what is the electricity rate, it is not known before. That's why these elements of cost, like the electricity rate or labor wages, these are called secondary cost elements. This is different from something called a primary cost element, which may capture the actual labor wages at the end of the month. This is not possible to be known beforehand because you do not know which labor is going to work in which machine. But you do not know what exactly will be the electricity rate beforehand, because the electricity rate to be revised, or you don't know how much of lubricants will be consumed specifically for the machine. So that's why these rates and this rate multiplied by the hour at the time does not go into your financial account. It is only meant for management. Because financial accounting has to have the actual wages that you have paid, the actual electricity that you have been billed for, and that amount is sitting in your profit and loss. But the estimated ones are sitting in your management accounting, and you can do the costing. The closest you can do the process costing is based on this estimate. You can know the estimated time as well as the actual time. That is actually how many hours of labor has been used. But it is not possible to know the actual rate of labor that who has worked on your machine. That will always remain estimated. That is the best you can do for actual costing. It is not possible to measure the actual labor who has worked, what is the salary of that labor for 1 hour, and do the costing accordingly. If you want to do that, the overheads will be, or calculating that will be too time consuming, too complex, because if you then note every labor who is working on a particular production order, note down the salary, then there can be complications. The salary may get revised, etc. So that's why it is not actually worth it. However, we are not going into the process costing part of it in this particular video. We will restrict ourselves to the material cost, but because in order to understand the variance, we also need to know the process. We need to give the actual process cost. So here, the per unit process cost is taken to be ₹20. This is, again, as I mentioned, taken from the various components of the process cost, which we are not going in details in this particular video. But the standard processing cost for 1 unit of B is taken to be ₹20. Now, 1 unit of B requires 2 units of C to be made. Requires 2 units of C for making 1 unit of B under standard conditions. And the number of units of B planned to be made is 10. Remember, it is planned to be made, not actual. Now comes the actual. Now, under standard condition, to make 10 units of B, I should have required 20 units of C. But what happened? I consumed 22 units of C. Why I consumed 22 units of C? Maybe because certain units got broke while being used in the production order. Remember, do not confuse it the yield of the finished product of or semi-finished product of B. This is the raw material. The raw material itself was consumed more than what was initially planned. Because while, for example, fitting the raw material into the let's say the raw material is a brake kit, fitting the brake kit into frame, one of a couple of brake kits broke, or few brake kits fell from the vehicle or the forklift which was carrying the brake kit, etc. So there are so many kind of things that can happen in the shop floor, because of it there's wastage of material. So that is the reason why 22 units were consumed. It was not planned. It was not initially planned that it will consume 22. It is not a buffer also. It is just that while consuming, you saw that 2 units are additionally required. Okay, and usually these issues can happen in stages, because once you know that 2 extra units are required, then only you will issue 2 extra units. Now coming to the processing cost, while actually doing the production, you saw that when the labor was supposed to work for 2 hours, labor actually worked for 2 hours, 10 minutes. Maybe the labor took 10 minutes more break time. Okay. So the actual time taken to produce was more than the actual time. Now, when that got multiplied by the standard rate means the rate of using the labor for one. Actual time multiplied by the standard rate gives you the actual processing cost. Note that you will never get the actual rate. You will only get, the closest you can get is the actual time multiplied by the standard rate. Why you will not get the actual rate? Because the reasons I just now mentioned, I do not know, or is extremely extremely time consuming, resource consuming to individually identify which labor worked on this particular production order and what was the salary of that labor at that point of time, and divide it by number of days, whatever, and get the hourly rate of exactly the labor who has worked on this machine. It will be extremely time consuming, resource consuming to do that calculation. Industries will typically not do that. They will live with that estimated rate, which is the average rate of it, and calculate the actual processing cost based on the actual time, because time you can measure. You can use a stopwatch or something like that, by which you can measure the actual time. These days, you are using data directly from the machines to get the time that was required to complete the job. And the rate is taken as a standard rate, which was calculated at the time of standard process. Okay. So that's why this actual processing cost is the actual time multiplied by the standard rate. Now comes the C. Remember, we say the C is a raw material, which is valued at moving average price. And by definition, moving average price will be changing, because every time I purchase, I may be purchasing at a different price. And it so happens that the time when the production is processed, at that time, the moving average price has increased to rupees 12 instead of 10, which was the moving average price at the time of standard cost estimate. So now, when goods are consumed, that means C is consumed for the purpose of production, C is consumed at the rate of rupees 12 instead of rupees 10. And that needs to be accumulated when we are calculating the actual cost of B. Finally, we thought that we are going to make 10, but what happened was, at the end of the production process, 2 units of B had to be scrapped because their production was not of good quality, their defects, and we're assuming that this scrap has a 0 value. The scrap will not be used anywhere, it will not be reworked on, it will not be sold, it has no value, and the number of units of B which has a value that has been produced is 8 instead of 10. Now, why this understanding of scrap as 0 value is important is because in reality, scrap is never of 0 value, or scrap is hardly of 0 value. There is some value to the scrap. If nothing else, probably we'll just we'll just sell the scrap as a by weight and recover some money. However, in SAP, scrap is treated as 0 value. If you think scrap has some value, this has to be recorded as a byproduct with a separate material code. We will not get into that costing now. That is the byproduct costing. That's another area of costing, and that can lead to a lot of debate actually, because how do you value a byproduct? So it's again a lot of process improvements and process engineering that needs to be done over there. But in this video, I'm not getting into the issue of byproduct. So here we'll assume scrap is of 0 value. So if this is a scenario, let's now figure out how planned versus actual material cost will be calculated. So first of all, you have to calculate what is the per unit standard cost of B. So how will I calculate the per unit standard cost of B? Per unit standard cost of B is the cost of raw materials at the time of standard cost doing the standard cost estimate plus the cost of processing under standard condition. So what is the cost of raw materials at the time of under standard condition and the time of standard cost estimate? We know that the moving average price is ₹10, and we know for 1 unit of B, I require 2 units of C under standard condition. So the price of the cost of raw material that will be required is 10 multiplied by 2, 20 rupees. And we also know under standard condition, 1 unit of B, the processing cost is ₹20. So 20 plus 20, 40. This is the standard cost of B. Okay. Now, how much was B actually produced? Not 10 units, 8 units were actually produced. So the standard cost of B produced will be 320, which is 8 multiplied by 4. It is very important to understand how valuation of semi-finished and finished goods happen in the industry. Valuation means that if you have a stock in your inventory, what is the value of the stock? What will be the value that will go into your balance sheet? Inventory is an asset, current asset. So it has to go into balance sheet. What will be the value of the stock in the balance sheet? Now, still few years back, this value of the inventory was done based on actual cost of that particular inventory. That means what was the actual cost to produce 8 units of B, which we are going to soon see. However, with new accounting standards and modern accounting coming in, also in India, now the practice is to value the inventory at standard. That means if I have 8 units of B in stock, I have a current asset worth ₹320, which is the standard cost of B, not the actual cost. We'll understand why this change and why this is the recommended way of showing the inventory value. Before that, we'll get into the actual cost. Now let us understand what is the actual cost of these 8 units of B produced. In order to find out the actual cost, again, actual cost will consist of 2 parts: the material cost, which is the cost of C consumed, and the processing cost. Now, what is the cost of C consumed? Now, we know that instead of 20 units of C, which should have been consumed to make 10 units of B, we consume 22 units of C. So that's the actual quantity of C consumed. Multiplied by the rate, the price at which C was, the prevailing price of C at that point of time, which is the moving average price of C at that point of time, which is ₹12. This is different from the moving average price, which was there at the time of standard cost estimate. So 22 into 12 will be the actual material cost. And what will be the actual processing cost? The per unit processing cost, actual processing cost is ₹25. It's supposed to be 20, it's 25. Where is the difference? The difference is because of the quantity of the number of hours of processes that have been used, not because of the rate. We cannot find out the difference in the actual versus standard rate. The only difference that can be captured is the quantity. Instead of labor working for 1 hour, the labor worked for 1 hour, 10 minutes. Okay. He or she took a 10 minutes break. Multiplied by the actual, multiplied by the standard rate will give you the actual processing cost. Now, this actual processing cost was for not 8 units of B produced, but all the 10 units of B produced. Because understand this, that we have done the process, the labor has worked, the machine has worked to make 10 units of B. But in the end, instead of producing 10 units of B, 2 units got rejected. So we still have consumed the processing cost of 10 units of B, but ended up rejecting 2 units of B as scrap. The processing cost will be 10 units of B multiplied by. And if I do that calculation, I'll see the total actual cost is 514 units. So the value of the inventory of B lying in the stock is 320 rupees. That means this should have been the cost of producing 8 units of B, which is the quality, B which has passed the quality. Yes. But you ended up incurring cost of 540. This difference is your inefficiency. This is called the variance. Now, one of the important areas of management accounting is to find out from where the variance is coming. Because only when you know the causes of the variance, you will be able to control the variance. So I need to break down the variance. So first cause of the variance is the fact that instead of consuming 20 units of C, I consume 22 units of C. So I consume 2 units more. This cause of variance is called the quantity variance. How much is quantity variance contributing? 2 units of B multiplied by the moving average price at the time of standard cost estimate. Okay. We are not taking 10 and not 12 because we don't want to see the difference of the price for for this particular line item, which is quantity variance. We only want to see what is the variance because of quantity. For this difference of price, 10 to 12 rupees, there is another variance, price variance. So that's why this 2 units multiplied by 10, 20 rupees is the quantity variance. What is the price variance? All these 22 units that I have used, they were all purchased. The moving average price was rupees 12 at that point of time, whereas during standard cost estimate, it was rupees 10. So these 2 rupees for these 22 units is because of the variance in price. That's why it's a price variance. What is the process variance? So instead of consuming 20 rupees per unit of B as a process cost, we incurred 25 rupees, 5 rupees extra, multiplied by 10 units of B that was planned to be produced because we have already consumed the processing cost. Later on, 2 units got rejected. Okay. So it is 50 rupees. Now, you may say that there are various intermediate operations and, I may not reject the 2 units after I do all the operations. In between the operation, after the 5th operation, let's say some units got rejected. In that case, for the remaining operations, I am not actually consuming so much of labor, etc. So much of labor means labor for 10 units, I'm consuming labor for 8 units. You're absolutely right. That will make the calculations more complicated, and SAP will do that calculation. But here, for simplicity's sake, I'm assuming that all the operations have been done and the rejection of 2 units has happened at the end of the last operation. That's why we are taking the processing cost for 10 units, which is planned to be produced, and not for 8 units that is actually produced. Okay. So that's the process variance. Finally, instead of 10 units, I produced 8 units. So 2 units I could not produce. It was defective. I produced, but it was defective. And 2 units multiplied by the standard cost of B. If I produce 2 units, I would have got another 80 rupees of inventory. That will be my yield variance. If you add now the quantity variance, the price variance, the process variance, yield variance, it will come to 194, which is equal to the. So this is how the material costing is done. And this is how you identify the variance. Let us now go to the next stage, which is the finished product stage. So A is our finished product, which which consumes, for simplicity's sake, only B for as an input component. So if you go back to our assumption, so just to make things a little more simple, here we have assumed that number of units of B required to make 1 unit of A is 1. That means if I plan to make 10 units of A, I require 10 units of B. The per unit standard processing cost of A is rupees 50. Again, the standard processing cost is calculated the same way as a part of standard cost estimate. Same method is adopted as we have discussed while estimating the standard cost of B. The number of units of A planned to be produced is 8. Why 8? Because now the production manager knows that I have only produced 8 units of B in my previous process. I planned to make 10, but 2 got rejected. So I can make maximum 8 of A. I cannot make 10. So that way. And just to make things simple, this time we are not considering yield variance. Let us assume that the yield was 100% and actually 8 units of A was produced. You can try with lesser amount of A and calculation will still remain, principles will still remain the same. For example, if you produce 7 units of A instead of 8 units of A, there will be yield variance. The actual per unit processing cost of A for the production order is around rupees 55. Again, remember the same principle what we discussed for the actual processing cost. The time will vary for an activity type like a labor or a machine. The rate will not vary. It is not possible to capture the actual rate. Okay. And the actual number of units of A produces 8. So we are not losing anything in consuming B. So B consumed is still 8. 8 units of B is consumed. So there is no loss there. That means we are not consuming 10 units of B to produce 8 units of A. Similarly, the yield also is, we are not losing anything as far as the yield of A is concerned. I think previously I just by mistake mentioned that actual units of, I thought it is actual unit of A produced is actual unit of B consumed. So that means I am not consuming more inputs than what is planned. Okay. Similarly, I am producing with yield 100%. I am producing the same number of A as initially planned. Now, I have made this simplified just to show you one important calculation in this particular phase. But if you want to change these numbers, for example, you want to say that actual number of B consumed is 10 instead of 8 and find out the quantity variance, you can do that. Similarly, if you want to say that actually 6 units of A was produced instead of 8, you can find out the yield variance also for the same process. The formula is also there in the sheet. So first of all, what is the standard per unit cost of A? Simple, 90 rupees, because now I have to take the standard cost of B, 40 rupees, which is 1 unit of B is required to make 1 unit of A under standard condition, plus 50 rupees of processing cost, so 90 rupees. The important part is the so now if I look at the standard cost of A produced, that means I've produced 8 units of A, is 8 multiplied by 97. So value of A produced is 7. We'll talk about this valuation part very soon. What is the actual cost? Now, this is the most important part. Now, actual cost of A produced will be the cost of B consumed in the production of A and the actual processing cost. Actual processing cost is simple. We saw 55 rupees per unit actual processing cost multiplied by 8, which is the number of units of A produced. That's the actual processing cost. That part is simple. But the confusion can come as to the actual cost of B consumed. One argument can be that the actual cost of B consumed, how many units of B has been consumed? 8 units. 8 units multiplied by the actual cost of B. Actual cost of B for 8 units is 514, which was there in the previous process. So it can be actual cost of B consumed. But in standard cost principles, you do not take the actual cost of the input material. If the input material is a semi-finished goods, you take the standard cost of the input material, which in this case is 40. So 40 into 8 plus 55 into 8. That will be 760. That is the actual cost of A produced. And if I go to the variance, you see there will be no quantity variance because no additional quantity has been issued or B has been issued. No price variance because B cannot have any price variance because B is valued at standard cost. So there cannot be any price variance unlike profit. Price variance in this case will always be zero. Process variance is the only variance that we have here because 5 units were additionally, 5 rupees were additionally consumed for the process, and for 8 units of A, that was 40. There is no yield variance here because we plan to make 8 units of A and we have made 8 units of A. Now, this is how the actual costing of A is done as per the standard cost process. Now let us understand that why did we use the standard cost of B to calculate the actual cost and not the actual cost of B to calculate the actual cost of B. There are two perspectives that you need to look at. One is the management accounting perspective, the other is the financial accounting perspective. Let us first handle the management accounting perspective. The management accounting practice, in the management accounting practice, if I had calculated the actual cost of A produced based on the actual cost of B, then the quantity variance, the price variance, the yield variance that we had calculated for B, these are the inefficiencies while producing B. Those inefficiencies also would have got loaded to A. That means this 194 rupees inefficiency would have got added as an inefficiency while producing A. That means the variance would have for A would have been 40 rupees plus 194 rupees. Because 194 rupees was the variance of B and we're carrying forward to A while calculating the cost of input material B at moving average price. At actual price. Now that is not fair because if you look at two separate processes of making B versus making A, the process of making A was only inefficient to the extent of 40 rupees, not to the extent of 40 rupees plus 194 rupees. 194 rupees was the inefficiency of making B. Let's assume there are two departments, one department making B and another department making A. Typically, that happens in factories. There are two departments responsible. Now, Department A will not take the responsibility of 194 rupees of inefficiency, which was Department B's responsibility. So if 194 rupees gets added to the variance of A, that is unfair on Department A. That is why from management accounting perspective, B should be valued at standard cost while being consumed in the process of. Now let us look at the financial accounting. What will happen if I issue B at the actual cost while making A? Issue happens from the inventory. That means I have to value the inventory of B at actual rather than standard. That means when I produced 8 units of B, the value of that B lying in my stock will become 514 rupees and not 320 rupees. Now, this will mean that in my balance sheet, my current asset will become 514 rupees, which is an inflated value of my current asset. Why an inflated value of my current asset? Because if I was efficient, if my plant was operating efficiently as it should, then I actually should have produced 8 units at 320 rupees, not 514 rupees. So by valuing the inventory and actual cost, I'm inflating my current asset. Now, obviously, if one side goes up in accounting, something else has to come down. What is that? It will come down. Now, this difference between 514 and 320, that is what? That is my inefficiency. If I'm inefficient, what should get affected? My profit should get affected. So, if I value my inventory at 514 rupees, my profit, on the other hand, will become higher by 514 minus 320. In other words, my loss will be booked less by 514 minus 320. This is where this method of actual costing for valuation of inventory does not give a fair picture of the company's state of affairs. And that's why recent accounting standards recommend that inventory of semi-finished and finished goods are valued at standard, not at actual. And they recommend companies to go for standard costing. If I value the inventory at standard, that means what will happen? The 8 units of B that I've produced will be valued at 320. The inventory will be 320, which is the value of the inventory if I was efficient. Because I'm inefficient, to the extent of 514 minus 320, this amount of money should be booked as a loss in my P&L, which is my true picture of the state of affairs, because I'm inefficient, so I'm incurring losses. So that's how standard cost estimate helps organizations to give a better financial and management account. And most accounting standards do that. However, for organizations moving from actual to standard costing, there is a challenge, because the movement has to happen in one financial year. It cannot happen gradually. One financial year, you have to declare that you have changed the valuation from moving average to standard. Now, the year when this happens, there will obviously be a hit on your balance sheet and P&L. That's why many management tries to defer this decision, because no management wants to give the explanation to the shareholders that why the inventory has come down, the assets have come down, and that losses have increased or profit has come down because of this. Though obviously in the annual statement there'll be qualifiers, there'll be comments on this, that the valuation of the inventory has changed, but many people may not read that, and the general stock market sentiments may go down moment the annual reports are released. That's why many companies try to postpone this as well as possible. So I hope this principle is clear, how standard costing and actual costing for materials are done. We very briefly touched our process, but we didn't go into details of the process costing in this particular place. So this cost costing is based on whatever we discuss is based on activity-based costing, because this labor, machine, etc., these are all activity types. Okay, in SAP also they are considered activity types. So that's why it is activity-based costing. So those of you who have studied activity-based costing on theory, you can see how they are implemented in ERPs like SAP. Now let us look at one simple cost report. There are many cost reports in SAP at various stages. The one that we are seeing is a very simplistic cost report, and we are trying to understand the implications of the material cost that we discussed just now. So let us go there and in SAP and see the report for analysis of cost.